In this video, I will be sharing an amazingly powerful scalping strategy that provides setups daily, along with a high win rate. I found this strategy a couple of years ago on a trading forum. It was mainly used for Forex, but I did test it on some indices and it worked perfectly fine. I have extensively back-tested it on a couple of assets like gold and Forex. Although, I suggest you test it yourself before using it. Before we start, be sure to hit that like button and subscribe to our channel so that you don't miss any of our new videos. With that being said, let's get into this video. When we talk about scalping strategies, most of them are trend-following strategies. This is because intraday trends can be very powerful. But the strategy that we will discuss today is a mean reversion strategy. A mean reversion strategy follows the theory that the price will eventually return to its mean or average price before making a further move. Let me explain this concept in a bit more detail. Whenever the price makes a strong and sudden move, we can say that the price is stretched. Just like a rubber band, when the price gets stretched, it tends to snap back to its mean or average before moving forward. In terms of technical analysis, we can find the mean by using a simple moving average. For instance, look at this chart. Here we have a simple price chart that is accompanied by a simple 50-period moving average. Just like the name suggests, the moving average simply calculates the average price over the past 50 candles. Focus on these points. On these points, we see that the distance between the price and the moving average is huge. Whenever the price moves far away from the moving average, it snaps back and moves towards the moving average before making another move. This is the mean reversion model. Whenever the distance between the price and the moving average increases, the moving average acts like a magnet in attracting the price towards it. The question now is, how do we create a strategy that exploits this market tendency? So, now let's understand the strategy. For this strategy, we will mainly use two indicators. The first indicator that we will use is the Bollinger Bands indicator. The Bollinger Bands are a very popular indicator that helps us in identifying market reversals. Bollinger Bands consist of three lines. The middle line on the indicator is a simple moving average. By default, the Bollinger Bands are set to 20 in two settings. This means that the middle line here is a 20-period moving average. The upper line is calculated by adding two standard deviations to the moving average. This creates an upper boundary for the price. Similarly, the lower line is calculated by subtracting two standard deviations from the moving average. This forms a lower boundary for the price. The general rule for the Bollinger Bands is that 90% of the price action occurs within these bands. Rarely do we see the price move above or below these bands. When the price moves above the upper band, we expect the price to find resistance and reverse downwards. Similarly, when the price moves below the lower band, we expect the price to find support and move upwards. So we will use the Bollinger Bands to identify reversal opportunities. We will use the Bollinger Band on the setting of a 100-period moving average with two standard deviations above and below it. When the price is above the upper band, it indicates that the price is stretched, and we can expect a down move. So we will look to sell in such cases. Similarly, when the price is trading below the lower band, it indicates that the price is stretched downwards, and we will look for buying opportunities. An important point to remember here is that we will need some kind of confirmation before we enter a trade. That confirmation will come from looking for divergences in the MACD indicator. MACD is a simple indicator that oscillates from the values of +400 to -400. It consists of the elements, the MACD line, the signal line, and the histogram. For this strategy, we only need the histogram. So we will remove the signal line and the MACD line. Now, we are left with the histogram. We will look for divergence on the histogram to confirm our entries. A divergence occurs when there is a conflict between the price and the indicator. Divergence can be of two types: a positive divergence and negative divergence. A positive divergence occurs when the price makes a lower low but the indicator makes a higher low. It signifies that the down move has lost its momentum and the price might be ready to move up. On the other hand, a negative divergence occurs when the price makes a higher high but the indicator makes a lower high. This shows that the up move has lost its momentum, and the price may reverse downwards. Now, we will combine the Bollinger Bands and divergences to identify trade opportunities. When the price goes above the Bollinger Bands, we will look for a negative divergence on the MACD. When we identify a negative divergence, it will confirm our downside bias and we can enter a short trade. Similarly, when the price is trading below the Bollinger Bands, we will look for buying opportunities. For that, we will look for positive divergences on the MACD. The positive divergence will confirm our bias and we will buy here. Let's look at some examples to understand the strategy. On this chart, we have a very clear example. Initially, we see that the price was in an uptrend. Then, on this candle, we see that the price broke above the upper Bollinger Band. This tells us that the price has been stretched to the upside. Hence, we can expect a reversal to the downside. But, we cannot simply enter a sell trade. If we did so, we would have been at a loss because the price kept on moving up. So, we need to wait for a divergence to occur on the MACD indicator. And sure enough, we see a divergence appear on the MACD. Here, we see that the price created higher highs, but the MACD created lower highs. This is a bearish divergence. The bearish divergence indicates that the price is ready to move downwards. Therefore, the Bollinger Bands and the MACD confirm that the price is overbought and it is about to move down. We will take an entry on this candle as the price closes inside the upper Bollinger Band. We will keep our stop loss above the most recent swing high and we will exit when the price touches the middle band, that is the 100-period moving average. And as you can see, the price achieved our targets on this trade. Let's look at another example. On this chart, we see that the price broke below the lower Bollinger Band and started trading lower. This clearly shows us that the price is extended to the downside, and we can expect the price to move up very soon. But, we cannot simply place a buy trade here. We have to wait for a confirmation on the MACD. The confirmation happens when the price creates this lower low, but the MACD creates a higher low. This is a bullish divergence. It indicates the down move has lost its momentum and it is ready to make an up move. Therefore, the Bollinger Bands and the MACD confirm that the price is ready for an upside reversal. We need a candle to close inside the lower band for us to enter a buy trade. On this red candle, we see that the price opens inside the lower band, but it closes outside the lower band. So, we need to wait. On the next candle, we see that it closes inside the lower band. This is our buy trigger. So, we enter a buy trade here. We can keep our stop loss below the recent swing low, and we can exit at the 100 moving average. And as you can see, we made profits on this trade. So this was the mean reversion strategy that can help us in trading reversal like a pro. I suggest you paper trade this strategy before trading on it with real money. That brings us to the end of this video. If you like this video, then be sure to hit that like button and subscribe to our channel so that you don't miss any of our new videos. See you soon.